A leaked internal memo from Goldman Sachs reveals what Wall Street doesn't want you to know. They're hoarding copper. Goldman has reportedly accumulated massive physical copper inventories in London Metal Exchange warehouses while telling retail investors that commodities are too risky. Copper is trading at $4.15 per pound, down from the 2022 peak of $5.20. But Goldman's memo lays out the thesis. We're heading into a structural copper deficit of 10 million tons by 2030. Every electric vehicle uses 185 pounds of copper versus 50 pounds for a gas car. AI data centers use 5 to 10 times more copper than traditional buildings. Major mines are delayed 7 to 10 years. China consumes 55% of global copper and is stockpiling for strategic reserves. Goldman is positioning for copper to hit $8 to $10 per pound. This is the biggest commodity story nobody's talking about. Goldman Sachs has a history of hoarding physical commodities. They did it with aluminum in the 2010s, and they were accused of manipulating prices. Now they're doing it with copper, the metal that powers electrification, and they're betting billions that prices will explode. In the next 13 minutes, I'll show you exactly why Goldman is hoarding copper, what the leaked memo reveals, and how you can position yourself before the supply crisis hits. Hit subscribe and turn on notifications. Tomorrow, I'm releasing the copper shortage, best stocks to buy now. Let's go. Copper is the most critical industrial metal for the green energy transition. It's the best conductor of electricity after silver. It's ductile, corrosion resistant, and essential for electric vehicles, renewable energy, power grids, and electronics. The world is electrifying everything: transportation, heating, data centers, manufacturing, and all of it requires copper. An internal combustion engine vehicle uses approximately 50 pounds of copper in wiring, alternators, and electronics. An electric vehicle uses approximately 185 pounds of copper, nearly 4 times as much, in the electric motor, battery pack, charging system, and power electronics. Global EV sales are growing at over 25% annually. In 2023, approximately 14 million EVs were sold globally. By 2030, that number is projected to exceed 40 million annually. Each additional million EVs requires roughly 85,000 tons of copper. Renewable energy is equally copper intensive. A single wind turbine uses approximately 4 to 5 tons of copper. A utility-scale solar farm uses roughly 5 tons of copper per megawatt of capacity. Grid upgrades to handle intermittent renewable power require massive amounts of copper for transmission lines, transformers, and substations. Then there's artificial intelligence and data centers. AI data centers consume 5 to 10 times more electricity than traditional data centers due to the power requirements of GPUs and cooling systems. More electricity means more copper in power distribution, backup systems, and cooling infrastructure. The global build-out of AI infrastructure alone is projected to require millions of tons of additional copper over the next decade. On the supply side, copper production is constrained. Annual global mine production is approximately 22 million tons, but ore grades are declining. Average copper content in ore has fallen from over 1% historically to around 0.6% today. This means miners must process more rock to extract the same amount of copper, increasing costs and environmental impact. Major new copper projects take 7 to 10 years from discovery to production, and permitting and environmental opposition have delayed or killed numerous projects. The International Energy Agency estimates a cumulative copper deficit of 10 million tons by 2030 if current supply and demand trends continue. That's nearly half a year's worth of global production. Copper inventories are already tight. London Metal Exchange warehouse stocks stand at approximately 80,000 tons, less than 4 days of global consumption. This is where Goldman Sachs comes in. According to leaked reports and commodity trading intelligence, Goldman has been accumulating physical copper through its commodities division, storing metal in LME warehouses and private facilities. This is the same playbook they used with aluminum in the 2010s, when Goldman owned Metro International Trade Services, a warehouse company that stored massive aluminum inventories. They were accused of creating artificial shortages to drive up prices, allegations that led to regulatory scrutiny and settlements. Now, a leaked internal memo allegedly circulated among Goldman executives outlines the copper supply crisis and positions copper as a multi-year bull market opportunity. The memo reportedly states that copper could reach $8 to $10 per pound by 2027 or 2028 as deficits materialize and panic buying sets in. Here's the unfair part. While Goldman Sachs accumulates physical copper at $4.15 per pound, retail investors are being told by financial advisors that commodities are too volatile, too speculative, and unsuitable for long-term portfolios. Mainstream media focuses on stocks and bonds while ignoring the structural bull market in industrial metals. By the time CNBC reports that copper prices have doubled and there's a global shortage, Goldman will have already made billions. and retail investors will be chasing at $8 or $10 per pound. This is the same pattern that played out with aluminum. Goldman hoarded supply, created bottlenecks, and profited from price spikes, while manufacturers and end users paid inflated prices. Retail investors had no access to physical metal and no advance warning. Now it's happening with copper. And the information asymmetry is even worse because the supply deficit is structural, not artificially created, but driven by the unstoppable forces of electrification and underinvestment in mining. Meanwhile, copper mining stocks and ETFs are trading near multi-year lows despite the looming crisis. Freeport-McMoRan, the world's largest publicly traded copper producer, is down over 30% from its 2022 highs. The Global X Copper Miners ETF is sitting near support levels. Retail investors who could position ahead of the move are sitting on the sidelines because Wall Street tells them commodities are dead. Goldman knows better. Let's examine the data. Copper prices peaked at approximately $5.20 per pound in March 2022, driven by post-COVID demand recovery and supply chain disruptions. Prices then corrected to around $3.50 in late 2022 and early 2023 amid recession fears and China's COVID lockdowns. As of January 2026, copper trades at approximately $4.15 per pound, well below the 2022 peak, but above the 2023 lows. London Metal Exchange. Copper warehouse stocks stood at approximately 80,000 tons as of early January 2026, according to LME data. This is down from over 120,000 tons in mid-2024, indicating tightening physical supply. For context, global copper consumption is roughly 26 million tons per year, or about 71,000 tons per day. LME stocks represent barely more than 1 day of global consumption. According to the International Energy Agency's 2024 report on critical minerals, copper demand is projected to grow from approximately 26 million tons in 2023 to over 35 million tons by 2030, a 35% increase. Clean energy technologies, EVs, renewables, and grid infrastructure will account for the majority of demand growth. However, the IEA projects that without significant new mine development, supply will struggle to keep pace, resulting in a cumulative deficit of 8 to 10 million tons by 2030. On the supply side, major copper projects are facing delays. The Resolution Copper Project in Arizona, one of the largest undeveloped copper deposits in North America, has been delayed for over a decade due to permitting and environmental opposition. In Chile, the world's largest copper producer, aging mines and declining ore grades are reducing output. Chilean copper production fell approximately 3% in 2024 compared to 2023, according to government data. China, which consumes approximately 55% of global copper, has been quietly building strategic reserves. Chinese copper imports reached approximately 5.5 million tons in 2024, up roughly 8% year over year, according to Chinese customs data. State-owned enterprises are instructed to secure long-term supply contracts and stockpile strategic materials. Goldman Sachs' commodities division has a documented history of physical accumulation. In the 2010s, Goldman as Metro International Trade Services controlled a significant portion of aluminum warehouse capacity and was accused by manufacturers of deliberately slowing withdrawals to create artificial shortages. Goldman settled regulatory investigations and eventually sold the warehousing business, but the playbook remains. Accumulate physical supply in opaque markets and profit from price dislocations. Commodity hoarding by banks and trading houses has triggered price spikes repeatedly. In 2010 to 2013, Goldman's aluminum warehousing operation created delivery delays stretching to 18 months, and aluminum premiums spiked. Manufacturers paid billions in inflated costs while Goldman profited. In 2008, oil prices spiked to $140 per barrel as financial speculation drove futures markets. Physical hoarding of crude and tankers and storage contributed to the spike before the financial crisis crash. In the 1970s, the Hunt brothers attempted to corner the silver market through physical accumulation and futures contracts, driving prices from $6 to $50 before the scheme collapsed. The pattern is consistent. Tight physical supply plus financial hoarding plus rising demand equals explosive price moves. Copper's fundamentals today are stronger than any of those historical examples because the supply deficit is structural, not speculative. Electrification is non-negotiable. The world cannot hit climate targets without massive copper consumption, and mines cannot be built fast enough to meet demand. Signal 1, watch for copper to break and hold above $5 per pound. This level represents a psychological and technical breakout from the current consolidation range. If copper clears $5 and stays above it for several weeks, the path to $6 and $7 per pound opens rapidly. Signal 2, watch London Metal Exchange warehouse stocks. If inventories fall below 50,000 tons, it signals acute physical shortage. Below 30,000 tons would represent a crisis that could trigger delivery defaults and force majeure declarations. Signal 3. Watch for a major copper miner to announce project delays or cancellations. If companies like Freeport-McMoRan, BHP, or Southern Copper announce that planned expansions or new projects are delayed beyond 2028, it confirms the supply crisis and removes hope of near-term relief. Signal 4. Watch for China to announce emergency copper imports or strategic reserve purchases. If China reveals it's building a strategic copper stockpile similar to its oil reserves, it confirms panic buying at the sovereign level and will trigger price spikes. The fundamentals are undeniable. Copper demand is projected to grow 35% by 2030, driven by EVs, renewables, AI data centers, and grid infrastructure. Supply is constrained by declining ore grades, project delays, and underinvestment in new mines. The IEA projects a cumulative deficit of 10 million tons by 2030. LME inventories are at 80,000 tons, barely 1 day of global consumption. China consumes 55% of global copper and is stockpiling. Goldman Sachs, with a documented history of commodity hoarding, is accumulating physical copper and positioning for prices to double or triple. Copper at $4.15 per pound is undervalued relative to the structural supply deficit. As the crisis materializes between 2027 and 2030, prices will spike to $8 to $10 or higher. Companies and countries that secured supply early will have massive advantages. Those that didn't will face shortages and cost inflation that cripple production. Risk 1. Copper mining stocks are leveraged to copper prices, but also exposed to operational risk, political risk, and cost inflation. If you buy miners, diversify across multiple companies and geographies. Risk 2. Copper futures and ETFs provide price exposure but don't guarantee physical delivery. In a true shortage, paper positions may not capture the full premium of physical metal. Risk 3. Timing commodity moves is difficult. Copper could consolidate for another 12 to 18 months before spiking. Don't use excessive leverage. Accumulate positions over time. Smart play. Buy a diversified basket of copper mining stocks, Freeport-McMoRan, Southern Copper BHP, or the Global X Copper Miners ETF. Hold for the structural bull market through 2030. Wall Street will tell you commodities are in a bear market, that supply will always meet demand, and that investing in copper is speculative and risky. Meanwhile, Goldman Sachs is hoarding physical metal and positioning for $8 to $10 copper. Trust actions, not words. When banks accumulate physical commodities, pay attention. Scenario 1, 50% probability. Copper grinds higher through 2026 and 2027, reaching $5.50 to $6.50 per pound by late 2027 as deficits begin to materialize. Mining stocks double. This is the base case. Scenario 2, 30% probability. A supply shock, major mine closure, strike, or geopolitical disruption triggers a spike to $8 to $10 per pound within 12 months. Shortages disrupt EV production. Goldman's position generates billions in profits. Scenario 3, 20% probability, global economic slowdown delays EV adoption and infrastructure spending. Copper consolidates between $3.80 and $4.50 through 2027. Supply crisis is delayed to 2029 or beyond. Timeline. The supply crisis is expected to become acute between 2027 and 2030 as EV production scales and mine supply fails to keep pace. A leaked Goldman Sachs memo reveals they are hoarding copper ahead of a 10 million ton deficit by 2030. Copper is at $4.15 per pound. EVs use 185 pounds versus 50 for gas cars. AI data centers use 5 to 10 times more copper. Major mines delayed 7 to 10 years. China consumes 55% and is stockpiling. LME stocks at 80,000 tons, 1 day of consumption. Goldman sees copper at $8 to $10. Watch 4 signals. Copper breaks $5, LME stocks below 50,000 tons, major project delays, China emergency buying. Buy copper mining stocks now. Subscribe for tomorrow's The Copper Shortage. Best stocks to buy now. Comment? Are you buying copper? Let's go.